And the article said, when does it make sense to borrow against your home's equity? Well, again, if you've been watching this show, you know I've been talking about this quite a bit. But the basic gist of the article is, if you're going to look at getting some of your equity out of your home, if you're going to pull that out, you want to consider what your plan is, which of course means you should have a plan. And is there a long-term benefit? And I'll come back to that in a second. Some interesting stats, current stats, second quarter 23. HELOCs and HELOCs jumped by 53% and 21% respectively in terms of applications. So that's a big increase in both fixed rate seconds, that's what a HELOC is, and variable rate seconds, that's what a HELOC is. So big improvement in activity for both. Certainly a much greater rate of improvement over first mortgages right now. The biggest reason, reno or renovation. That is leading the interest in equity loans driven by lots of homeowners who are in a locked up real estate market that cannot give up, don't want to give up that 2.5% mortgage. They got a lot of equity, and instead of selling their home and buying a bigger, nicer, they're going to take some of that equity, improve their current home, and stay put. The other big issue is debt consolidation. That's probably the number 2 reason people get equity loans. And that's driven by credit card debt, now over $1 trillion in the U.S. So that's the second biggest reason for tapping your home equity. And does it make sense to tap your home equity for these 2 reasons? I would say yes, with some qualifiers I'll mention in a minute. Pros to getting an equity loan. They're generally going to have better rates than unsecured loans. Unsecured credit cards for sure, unsecured personal loan, they're going to have better rates. Flexibility. Well, that's true with the HELOC, not the HELOC. HELOCs are very popular because of the flexibility. Draw on the account, pay it down, draw on the unused portion again, pay it down, draw again. You can do that with most HELOCs for up to 10 years. Plus the fact, because it's a secured second mortgage on your home, you may have potential tax benefits. Check with your tax advisor to confirm, but you certainly have that potential over an unsecured loan. The cons of equity loans: borrowing costs. You can see some closing costs on equity loans and HELOCs, both in terms of limited escrow and title fees, appraisal fees, although in those cases, most of them are automated valuation appraisals, so their costs are very low. You could see some origination fees on HELOCs depending on which rate option that you choose. Loss of home. It's a second mortgage. It's secured by a home. If you don't make the payments at the extreme, you could lose your home through a foreclosure because it is a mortgage. So you want to keep that in mind. And of course, the risk of rising rates. If you're on a HELOC, that is a risk. Most folks getting a HELOC right now are taking a bet that they think HELOC rates are going to pause and maybe start falling because they think the Fed is near the end of their strategy of raising the Fed funds rate to fight inflation. So when is an equity loan a good idea? Well, the first thing I would tell you, and it's mentioned in this article, don't use it for unnecessary expenses or vacations. A lot of times with a HELOC, you'll get essentially a debit card. Don't use that for dinner out. Don't use that for groceries if you can. I mean, it's just not a wise use of the funds. You want to remember, you want to have a plan, and you should have a long-term benefit. So short-term unnecessary expenses or vacations, things like that, generally not advisable to use a HELOC for that, because again, you're putting that debt on your home, and it could take you a while to pay that off or pay it back. So for certain expenses, it doesn't make sense to do that. Paying off short-term debt is a good thing. And of course, most of the time that's credit cards. But with that, you should combine that with a commitment. I say a commitment to avoid short-term debt again in the future. So if you're going to use a HELOC to pay off a lot of money in credit cards, great idea. You're going to save a lot of money in interest on a HELOC rate versus your credit card rates, but really change your behavior and avoid getting those credit card balances back up again in the future. Otherwise, you've wasted your home equity on paying off short-term debt. That debt comes back, re-arrives, if you will. You're back in the same boat, and you could eventually run out of equity to keep doing that. And so you want to avoid that process to start with. If you're paying off credit card debt, figure out a way to put those credit cards in a drawer and avoid using them as much as you can. And again, use the funds for tangible long-term benefit. If you've got a minor repair at your house, try to avoid a HELOC if that's what you've got. The way I think about it is if you're going to use a HELOC, use it for something that's going to be long-term, improvement to your house, or maybe in some sort of investment that's going to give you a return in the future. I also often say that a HELOC is like a credit card, but I'm going to suggest, yes, it's like a credit card in terms of how the program works, the structure of it, but don't use it like a credit card. Don't use your HELOC debit card for all kinds of little expenses just for day-to-day living. That's going to get you in trouble. So they're like a credit card, but don't use them like a credit card, to that same degree that credit cards tend to be used. Okay. So with that, kind of reminder again about home equity loans and the fact that they're very popular right now. I'm going to jump into the next subject, which is I have a new home equity loan product, another HELOC product that I want to share with you. And it's an exciting program. It's a little bit different. This one is going to appeal to someone who looking to tap into their equity. They have a really specific need. They have a specific amount of money. It's going to be probably more of a one-time use, like maybe a major home improvement project, like a kitchen remodel or installing a pool. Not necessarily something you're going to look at using time and again over the next 10 years. And most importantly, this program, it's a lot different because it's fully automated, fully online process, and you can actually get the loan in as little as 5 days. And the way this works is an eligible borrower is going to be able to access their home equity and get a line of credit. And it's available on single unit properties, either owner occupied, a vacation or second home. And most importantly, and this is rare, on a rental property. But again, a single unit rental property, no 2 to 4 units. So no duplexes, triplexes, fourplexes. Sorry about that. Now, the repayment period for this particular program ranges. You can choose as little as a 5-year term up to a 30-year term. You choose that as part of the application automated process because you're going to get proposals, and then you choose which term you want. And then depending on which term you choose, you will then get a draw period that's going to range from 2 to 5 years, depending on the loan term. So if you only choose a 5-year loan term, you're only going to get a 2-year draw period. If you want a 30-year loan term, you'll get a 5-year draw period. So that again is going to vary depending on what loan term you select. You get all the money at once. So this is not like some HELOCs, the other HELOCs I offer, where when you get the loan, you can you do have to meet the minimum draw amount, usually $50,000, but you don't have to draw more unless you want to. But this HELOC doesn't work that way. You have to take the full amount of the line of credit that you want. You have to take the full amount at closing. Again, you don't need it all at once. You can send the excess portion back, and you'll pay it back toward the loan. There are zero costs on the loan. Now, let me clarify that. Zero cost meaning there's no appraisal fees, title fees, that kind of thing. You will have an origination fee depending on the rate option you choose. Again, you're going to be given a proposal after you submit an application online that will give you the program interest rate and origination fee option. So you could have an origination fee, but literally virtually no other closing costs that you normally see associated with getting an equity loan. There's no prepayment penalty. There's no title report obtained on your property, which is a little bit different than most HELOC programs or equity loan programs. It's a fully automated underwriting and appraisal process. Again, fully automated. You apply 100% online. We can get the loan approval in as little as about 5 minutes. Maximum line of credit amount is $400,000. And for most applications, you only need a government-issued ID. Now, why would that be? Well, again, it's automated. For a borrower, a homeowner who is maybe employed and with a company that is a major company, these days it's quite possible to get verification of employment and your income through an automated process. Same with your bank accounts. So with that kind of automation available to be able to, in an automated way, verify your employment, your income, and your assets, that can dispense with having to provide pay stubs and W-2s and tax returns and bank statements. So in a lot of these transactions, not all, but a lot of these transactions, you may find that you have nothing to provide except your government-issued ID. So it's very streamlined, very quick, works a little bit differently than the standard HELOC, but it can be a great option for somebody who just needs the money, knows what they want, knows what they're going to use it for. They're thinking it's going to be probably more like a one-time use. This is a great way to apply online, minimal paperwork, fast approval, and most importantly, a very fast closing. So want you to be aware of this. If you want more information, feel free to contact me. Be happy to send you some numbers or give you more detail about the parameters and underwriting criteria for this new HELOC program that we're pretty excited about. Thank you, everyone. Thanks for listening. Thanks for watching. This is the conclusion of the Mortgage Minute for this week. I'm Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. So long. Take care.